Welcome back to the Main Street Meets Wall Street podcast. I'm Marcus Sturdivant Sr. Before we dive into the ledger today, I want to take a moment to address the scope of the intelligence we're discussing. For those of you following, you know our goal is not to provide the noise of the nightly news. It's to provide the structural signal of the global economy. And there is no more one critical to that signal than David Snyder. David's analytical rigor regarding the 1960s semiconductor cycle and the current AI hyperscaler mania is the gold standard of this space. David predicted the 2008 market lows as well as some market highs. David is bringing his full high conviction thesis to the table today. And we're looking at a fundamental burst of the AI bubble that will redefine the institutional playbook. But we're going further. This is not just a theoretical audit. Be sure to stay until the very end of this report where David reveals his own biggest investments mistakes and, more importantly, exactly how he's positioning his own capital in today's volatile markets. What you about to hear in this class, this episode is a structural realignment. To David, thank you for the in-depth, the consistency, and the courage to call the reality as the data dictates, not as the market expects. For our listeners, the ledger is open. Let's get to work. We dissected the historical architecture of market bubbles. But for the stewards of your family and people's multi-generational capital, that's only part of the baseline. Our mission here is grounded in several different structural intelligence. Geopolitical intelligence to anticipate regional friction, macro structural audits to track the real-time flow of institutional capital, and the tactical wealth preservation to ensure your family and your trust, whoever you're working for, remains shielded from structural decay. In part one, David Snyder laid out a compelling high conviction case. The current AI bubble is not just overextended, it's on the verge of a systematic burst. He argues that the hyperscaler spending frenzy we've seen in the final act of a distorted credit cycle is not over and it's going to be a major catalyst. But if Snyder is right, where does that leave your capital? We're moving into the second phase of this audit, the tactical realignment. The mere exposure effect has lulled the average investor into betting on a status quo that's fundamentally failing. You're not average. You need to know how the weaponization of trade routes like the Strait of Hormuz and possibly the Strait of Taiwan, looming fiscal recalibrations could force a rotation into your portfolio, regardless of whether the AI bubble bursts tomorrow, the next 6 months, 12 months, 18 months. So sit back over the next 60 minutes, stop looking at the sentiment, and we're going to start auditing some of this solvency. We're covering the defensive areas as well, so high yield credit and gold, the dollar, that serve as the hedge against some of these structural failures David describes. And if you've been waiting for a signal to review your portfolio and your estate planning and tax efficiency strategies, this is that signal. Ledger's open. Let's move to this execution phase.
Well, I mean, I think it's going to happen within the next 12 to 18 months. So one of the biggest signals is these major companies going public. Anthropic, ChatGPT, SpaceX, although it's not directly AI. That's a big warning sign. You have what could happen is, as I said, there's a lot of things that could go wrong. You're definitely going to get a deceleration. I mean, they've been growing CapEx by 50, 100% the last couple of years. It's definitely, even in the projections for 27 and 28, they're definitely going to slow down, although they'll probably raise those numbers. So there will be a slowdown. But there may be a point, you're going to look for, some kind of news where they're not getting. I don't think this is it, but the reports yesterday in the media about ChatGPT not meeting their goals on revenue. So if you get more of that kind of, commentary, that could be the tip of the iceberg to start. And it's all a vicious cycle. Once it's going to hit all the way back to suppliers, to the data centers, to the industrial companies that provide the electrification for the data centers. So everybody's tied into this cycle on AI. So they're all going to, if one gets hit at the top, everybody else is going to get hit, or all the way through the supply chain. So it can just be a vicious cycle on the way down. You know, there could be all kinds of things. There could be, you know, the chips aren't, you know, become so efficient, you know, you don't need as much data center power, you know, or just, you know, all kinds of things like that could happen. But the biggest thing will be, in my opinion, they won't get the return on investment, and then they'll have to slow down their CapEx. I think that's going to be the biggest issue. You know, institutions are slow to change. As good as this new AI technology is, it's hard. You're talking about having, you know, these systems ingrained in these corporations. To tear them out, you know, it's not that, it doesn't happen as quickly as people would hope for when something like this happens. People are slow to adopt these new technologies. So I think that's going to be an issue nobody's really thought about, that it will take more time. Even if the technology is that good, it'll take time to adopt. So that, you know, it's just going to be a slower, you know, pace. I mean, I heard yesterday somebody on CNBC say that they hope that it does slow down because that way it won't be, you know, get out of hand. And I'm thinking, no, if there's any evidence of a slowdown, all of the stocks are going to get hit really hard. It may be good for the long run, but you know, it would be a massive sell-off if you know, they all started to slow down their spending in the short term. You know, we're at a point of no return. I mean, if they start slowing down now, it's going to be, you know, a disaster. If they keep spending even more, you know, you're causing even more of a bubble. So they're in a you know, catch-22 at this point, the hyperscalers. So yeah, so I think it's a very dangerous. So there are so many, you know, you usually need a catalyst to get the market to go down, especially these hyperscalers and all the AI. So you know, you need some kind of, you know, we have these oil prices staying really high. You know, these are real companies, Marcus. So people think, oh, they're just going to adopt AI no matter what. Well, let me tell you, if oil prices stay high and we enter recession or just whatever slowdown, these companies have to cut spending. And people think they're not going to cut AI spending. No, they will cut AI spending, or they won't grow as AI spending as much as they were hoping to. So yeah, the overall economy can affect the AI spending. So, you know, but oil prices today, just what did I see, rose $5 to like 104? I mean, it's 7 weeks into this. So it could that could be the catalyst down the road if that continues. So yeah, we have, you know, every measure we're extremely overvalued in the stock market. So, you know, when you get to this level, it doesn't take much. You're very vulnerable to any kind of bad news because you're at such high valuations. And by the way, Mark, it's not just valuations. Everybody's saying the tech valuations are lower today than they were in the late 90s, which is true. It's really earnings. So earnings caused the collapse of the internet bubble more than the valuation. So you could easily get a 50% drop in tech earnings in a bubble burst. So right away, if you have a 50% burst 50% drop in tech earnings, and you remember the big bulk of tech earnings now with semiconductors doing so well. So you could see, if you have a 50% drop in earnings, you could easily see a 50% drop in the stock market, right? Because if you just stay at the same valuation level. So I'm not convinced just because the techs, and then you have the other industries like industrials, which support the AI. The industrials are trading at all-time high valuations. So it's not just tech that's causing the PE to be at 21. So you have a lot of other industries that are somehow attached to the AI revolution that would also come down dramatically. Marcus, this is so similar to the late 90s. It's almost too easy. You know, too easy that that the bubble will burst in the next 12 to 18 months. I mean, we've had 17 years of real returns in the S&P 500 of about 15%. That's exactly, almost to the day, it's very within months of the 1949 to 66 bull market and the 1982 to 2000. Both of those are about 17 years and about 15 to 16% real returns. Real returns are 6.5% a year over the last 100 years. You don't have to be a math genius to know. If you get 17 years of 15% real returns, and you average 6.5, the next 10 to 15 have to be like negative real returns, which is what happened between 2000 and 2009 when we had negative 3 or 4% a year returns or 3% a year returns. We are, we're following almost to a script what happened that ended the 62, the 49 to 66 and the 82 to 2000 bull markets, almost to and the other eerie thing is the biggest at the end, it was the semiconductors. And if you notice, the semiconductors have been on fire for the last 3 weeks. Well, I went back and in the internet from June of 96 until March of 2000, the semiconductor stocks, the index went up 8-fold. From October, using that's 3.5 years, right? From using October of 2022 until today, which is about 3.5 years, we're up about 6.5-fold in the semiconductor industry, which is these are like the 2 biggest increases in semiconductors ever. But the parallel, 3.5 years, almost the exact same parabolic increases as back in the late 90s. And by the way, we had the same thing in the late 60s with semiconductors, had this enormous run, and then the bubble burst. So we have that parallel, which is just scary. And both of those bull markets, Marcus, in the last 5 years is when a new revolutionary technology came out. And back then it was the integrated circuits, the Moore's Law, and also the aerospace. So you had, now this is the same way. We had the last 5 years has been the AI, just like the last 5 years in the 90s was the internet, and the last 5 years in the 60s was integrated circuits. It's crazy how closely they parallel. Also we had right now, price to cash flow is 28 times the S&P 500. That's the highest since the late 90s. We are the biggest discrepancy between price to cash flow and price to earnings since 99, 2000. Another incredible parallel. So we have just incredible, and then of course we have the parallels of the disruptions of every other industry going down, like software, and back then it was, real estate, and what we discussed before. So we have that parallel. I mean, there are so many parallels. It's crazy. It's just incredible to me.
Whew, yeah. All right. Hold on, David. Let's pull up and take a breath for a second there.
Okay.
You just gave Main Street a lot. People might be calling and trying to get out of all of their AI investments right now listening to this.
Right now. I'm not saying right now. I'm saying within the next 18 months.
No, you're good. I understand what you're saying.
And by the way, Marcus, don't forget, the biggest gains occur at the very end and the biggest losses occur at the very beginning of a bear market. So it's very difficult to time. If
possible to time almost,
Yeah.
I was going to say, just speaking back to the market, this market may be different though. I don't know. You've seen a lot of markets, maybe all markets are the same. So you talk about resilience and you mentioned China and how much cheaper they are using AI technology. We saw DeepSeek at the end of 24, if I remember correctly. And that was really like a Lehman Brothers moment for NVIDIA, if everyone remembers. It went really far down, but then it came back. And then we've seen, let's say, I'm just trying to think since DeepSeek, we had tariffs, which were, we saw what we did to the market. The market just moves different. And now we're in this Iran conflict. The market moves different. I don't know if it's the speed of information. I don't know if it's the retail investor. A lot of people invest in the market have never seen a recession, they've never seen the market go down. So people are sitting here listening to you speak right now, David. Go back and tell them a little bit about yourself and your history and what you've seen so they know. Pay a little bit of attention to this ghost whisperer we have on here right here.
Well, you're right. It seems different, but actually what's happened so far, Marcus, is exactly what you would have thought would happen. In other words, if I go back to March of 2009, when this secular bull market started, and if you had told me back then, Marcus, if you had told me, Dave, it's a new secular bull market, what's going to happen? And here's what I would have told you. I would have said we're going to have 17 years of about 15 to 16% real returns of a secular bull market. It's going to last 17 years. And at the last 5 or 6 years, I don't know what the technology is. We're going to get a revolutionary technology that's going to capture the imagination of investors. And it's going to cause a bubble. And the bubble is going to burst. And the secular bull market's going to end. So that's exactly what's happened so far. So nothing that has happened so far wasn't predictable based on the past 2 secular bull markets before this. I mean, we're perfect. It's almost a perfect. Now, But what I will tell you is if this lasts past next spring, then it will be different. Okay, then it will be different. But in those two, but Mark,
say that again for the listeners, David. What you just said.
If this secular bull market AI lasts past next spring, it will be different than any other secular bull market because that would last more than 17 years and the returns would still be, very high. But you're talking so not, you're talking about how the market bounced back from tariffs, from the oil spike, from the Iranian war. But in the late 90s, Marcus, we had the Asian crisis in 1998, and that was very severe. We had a depression in a lot of countries in Asia, and we had the long-term capital where they almost went under. So people were shocked how we bounced off of that and came right back. 98, like that was a 20% drawdown in a couple of months, just like the tariff did. But we bounced back immediately. And we had in 96, we had a high yield crisis and we had, different things happen and the market would keep coming back. And people would say to me, Dave, this market's incredible. It just comes back. It doesn't matter. People just buy the dips all the time. Yeah, well, that happened for 17 years. And then after 17 years, guess what happened? The internet bubble burst and everything went on. So when people tell me, Dave, this market's different, it's resilient, we have everything that happens to it, whether it was the inflation spike in 22 or the, tariff, tantrum in 25 or the oil spike to this in 26, the market just comes back. That's what happened. It's no different than what happened in the late 90s or the late 60s. So only if it continues past next spring will I be convinced that this is something different. And I don't believe it will. This one thing we haven't talked about much is productivity. Everybody thinks it's going to be the panacea, right? And it really hasn't happened yet. People keep quoting these huge productivity gains, right? However, we had negative productivity for like 4 or 5 quarters in 22 to early 23. So we have had increased productivity since then, but that's only because we have had a big, rebound from negative productivity growth in 22, early 23. So if you average that out, it's really not that great. And if you go back, I think I saw that after 20, productivity is only averaged a little over 1% a year growth after 21 and 22 until now. But everybody will quote you from mid 23 until now, and they'll say productivity growth is 2% or greater now. But that's just a function of a rebound from a decline. But here's the problem with productivity. In 2000, we had the highest productivity we ever had, 4.2%, I think it was. And the stock market went down, 15% that year. The economy went into recession the following year. My point is, it's not a panacea when it depends on the context. Productivity grew 3.2% between 2000 and 2004. That was higher than the 3% from 1995 to 99. Yet the stock market went down in real terms 4% a year from 2000 to 2004. So productivity growth was the highest ever. I mean, not the highest ever, but the highest in multi-decades from 2000 to 2004. And we had not so great economy, and we had stock market declines on average, annualized at about minus 5% on a real basis. So it's not a panacea. Even if we have a pickup and by the way, inflation went up in 2000 from 2.8 to 3.4%, even with productivity at 4.3%. So it depends where you are in the business cycle. If you're already close to full employment and inflation is starting to rise like it is now, the productivity is not going to save you. It didn't save us in 2000. I don't think it's, we have no labor force growth because of the demographics, as you know, because no immigration and because of the baby boomers retiring. We have a decline in the labor force, out there. So that means you are dependent on productivity for growth. I don't know if you know, from 1950 to 2000, the GDP grew about 3.5%. And of that 3.5%, about 40% was from aggregate hours worked. About 1.6% a year, aggregate hours grew. So you had almost 40% of GDP growth was aggregate hours. We can't grow aggregate hours now much, okay, because of the demographics. Aggregate hours are based on, how many hours the labor force increases every year. If you don't have increase in the number of people working, you're not going to grow aggregate hours. And with the demographics, it's going to be very difficult. So my point is, almost half of GDP growth came from aggregate hours work. Now, in the next 10 years, we're going to almost have no aggregate hours. So we're totally dependent on productivity. So if productivity does it needs to grow, over 2% in order to get GDP at 2%, because you're not getting you're losing that whole other growth factor. So that's something that people don't understand. So yeah, you will, even if productivity goes up a lot, it's not going to offset the loss of aggregate hours growth that was 40% of GDP growth from 1950 to 2000. So
Okay.
that's a big, big deal that people aren't thinking about, overall. And also within that, Marcus, even though aggregate hours grew 1.6% from 1950 to 2000, the number of hours people worked declined. But because labor force growth was so high, it was greater than 2%, aggregate hours can go 1.6%. So if we continue this trend of people working fewer hours in the workforce per week, per year, right? That's another, if you have no labor force growth, that's really going to take a hit on aggregate hours, right? It's really going to affect it negatively. So this is a major force, and it's a big reason. I'm doing a big thing right now on how the amazing thing is that earnings, GDP grew like 2% a year last decade, but earnings grew like close to 10%. And nominal GDP, we already grew like 5%, but earnings grew like 10% a year. Well, if you go back to, last 100 years, nominal growth equals GDP. GDP usually equals earnings growth, very close. In the last 20 years, earnings growth in the S&P has been way higher than nominal GDP growth. And the only way they did that was through the labor getting less percentage of sales, right? They're taking away from labor. And now we have this K-shaped economy. You can't keep taking away the revenue, giving more revenue to the owners versus labor and capital, giving more money to capital and owners. You can't keep doing that because K-shaped economies eventually die. They can't grow anymore. Because if you have very wealthy people that have most of the wealth, they're not going to spend, a high percentage of that wealth. Whereas the 50% or lower income groups spend most of their income. So we know there's all kinds of academic studies showing K-shaped economies will suffer lower growth. So I guess what I'm saying is, if we're going to get GDP growth by keep taking money from labor, sacrificing labor for profits, eventually that's going to turn on its head because the economy won't continue to grow. And we, as you know, I'm sure you're well aware, this is the most K-shaped economy ever in the history of the U.S. And it's dramatic between the haves and the have-nots. And that will, if it continues, will actually depress economic growth. So that's another big factor, which is also, Marcus, why you mentioned that everybody buys the dips, right? Well, here's the problem with a K-shaped economy. The wealthy keep spending and keep, as long as the stock market, there's more, I guess, economic growth has been more tied to the wealth effect today because of the K-shaped economy than any time in our history. So if you really do get a down cycle that stays down, so if the stock market somehow went down 20, 25% and stayed there for a long time, or whatever, you get the virtuous cycle. You get the cycle where it would actually affect the economy way more than in past bear markets. In other words, a bear market is going to affect the economy more than it ever has. That's another major risk. If we go in a bear market and recession induced, it's going to be really hard to come out of it because it's going to affect spending more than it would in other recessions. So we have that to deal with. My whole point of bringing up this earnings growth growing faster than GDP is that if you're going to have these high valuations in the stock market, you're expecting higher earnings growth or more stable earnings growth. Well, how are you going to have higher earnings growth if GDP is going to be less than it was, for the last century without sacrificing labor? So we have that, big big issue of how we're going to get growth in the future, right? With all those factors I just commented on.
So yeah, and that was a lot, and there was some salient points in there for sure. And obviously on the other side, we're looking at a new today while we're recording this. This will come out a little bit later, but this is presumably Fed Chair Powell's last meeting, right? So we have Warsh coming in. I think Tom tells us I'm down here in North Carolina, Wall Street, South Charlotte. Chairman Senator Tillis said he will allow the confirmation to go through the nomination up through the board. And so I know Warsh is more concerned with, he thinks AI is going to help the Fed in different ways. He's concerned about AI obviously destroying the economy, but he thinks it's a way that something that we have to embrace and it will possibly help us outgrow this economy. That's just such a diatribe or a divergence in the way that the world's looked at right now, because half of the people and the people in charge of our fiscal policy, by the way, and monetary policy think that we're going to outgrow this that we're at right now with the deficit. That's why they're looking to lower interest rates and reduce the amount of debt that we have so it's easier to service this debt that we're paying. And then they're praising AI for the productivity booms that it's going to bring. But as you just mentioned, AI and this productivity gains, especially when you see in the side of the earnings, the gap in earnings and real GDP, like seems like a formula for chaos. How do you see, Chairman, how do you see Warsh coming in and affecting this? Because the Fed could actually, this is something they could actually play a big part in, like whether we go into a recession or not. We'll take a quick break here and just set back.
Well, his number one goal is to reduce the Fed's balance sheet. So if he does that, that would probably cause long-term rates to go up. But he is going to definitely try, in my opinion, try to lower rates. I mean, he knows what Trump expects of him. So every new Fed chairman has been tested in the first 6 months. And what I mean by tested, the markets have taken the stock market or the bond market down within 6 months or a year of when a new Fed. So he's going to get tested likely. So I think the test could be he's going to want to lower rates when he comes in. With inflation still actually rising, especially with oil prices high, the market's not going to like that. And if he is able to convince the rest of the Fed to somehow lower rates, the vigilantes in the bond market could rebel. In other words, the longer-term Treasury bond market could sell off significantly because they think he's not going to be an inflation hawk. So that's how I think he might be tested, that he's being too dovish, or it could be that inflation actually goes up a lot and he refuses to hike rates. You know, so there's a big chance that he is tested within the first 6 months of his term, because for some reason the financial markets, like to test you. It's almost like a rookie in sports when he's on the first sports when he's playing as a rookie and they test you, whatever sport it is. So I think that's a very, probable, not most likely, if it's going to happen, that would be the most likely scenario where he's trying to lower rates. And the market doesn't like that, doesn't think that that's deserved. Hopefully, because the market, the Fed needs to restore their credibility. I mean, they've been calling for this 2% target inflation rate for 5 years. We haven't even been close to it. They're losing for me and for the financial markets, credibility for the Fed is one of the most important things for long-term investors in all financial markets. And globally, they've lost all credibility by keep pointing to this 2% inflation target. And here's the problem. So, people are more educated in running small and large businesses than they ever have. They know what the Fed target is. So if you're a business owner and he's got this 2% Fed target and you want to raise your prices by 3%, and you go, no, you know what? I'm only going to raise them 2%, right? Because if that's with the Fed, that's what everybody's going to do. So you keep your prices at 2%, and then inflation comes in at 3% every year, and then the Fed suddenly says, well, we're going to change our inflation target to 3%. Well, what's going to happen if you're a small business owner? You go, wait a minute, I sacrificed. I only raised 2% because that's what you said the inflation target was. Everybody else was raising their prices more than me because that's how we got to 3% inflation. And now you raise it to 3%. Well, you know what? I'm not gonna honor your expectation of 3% because you didn't honor your expectation of 2%. So I'm just going to raise my prices, 3-4% instead of 2%. If you follow that pattern, you lose, not only do you lose credibility, but you lose having an influential effect on inflation, because you lost the credibility, then becomes loss of influence. So it is a big deal. So he doesn't seem like he wants to restore that. So I don't, we'll see how it works out. But those are my views on the Fed.
Do you think the Fed stuck the soft landing?
Well, we still don't know. I mean, it's kind of funny because most recessions occur not when the yield curve is inverted, but when the yield curve inverts and then actually becomes positively sloped afterwards. So we're not totally through that yet. We had in 1990 we had a recession after the Fed. We had a big tightening cycle in '88, early '89, and then the Fed actually lowered rates a couple of times, and we still had a recession in 1990. So I mean, it is a possibility. You could still have a recession without the Fed tightening from here, if that, the lag effects, so that's still a possibility. But right now everything's on hold, which will probably be the case for at least the next couple meetings. So we'll have to see how that goes. But yeah, it's still a possibility. In other words, you don't have to have an inverted yield curve to have a recession. What you do need is to have a inverted yield curve that, a couple years before, and then become positively sloped. So we're still in that time period where it could happen.
Gotcha. Yeah, and when David keeps mentioning the inverted yield curve, that just means that the shorter term investments, treasury bills, somehow are higher interest rates than the longer term, whereas you should get longer term money for taking a longer risk where people are holding your money longer. But that is usually a reflection upon the government or whoever's issuing that note for them to pay it back. So definitely a salient point in there as well. The soft landing is definitely something we'll have to see. Was inflation transitory? I don't know. We'll see. I think Warsh is walking into plenty of challenges already. I mean, Powell had COVID pretty much right when he jumped in, right? And Trump actually had started some tariffs back then. There were some tariffs going on. Like that's when the tariffs initially started. They just stayed on through Biden's administration. So I think Warsh is definitely walking into some type of situation, to say the least.
And also, Martin, I don't know if we discussed this, but spending has exceeded income every month since the fall of 2024. So you can't do that forever. The savings rate's down to 4%. And even with all these tax refunds, which, by the way, came in lower than expected, the tax refunds, real disposable income from the time the tariffs were put on until like January was negative. Real wages are really slowing down. So you can't keep doing that. You can't keep spending more than your income. You can draw down your savings to a certain extent, but I don't think investors are aware that the consumer has been spending more than the increase in spending has been less than the increase in income for like a year and a half. And that's not good.
Yeah, it's definitely not good.
No.
And even as you mentioned, to go back a little bit further, when you were talking about the Fed's credibility and the 2% interest rate, and then, they set the COLA, cost of living adjustment, off of what's PC.
Yes.
They set that, and that number is still coming in higher. They say our target is 2%. Maybe the Fed should just say, like you said, that the target's 3%. That's where we're fighting with, and let business owners and Americans figure out, global community, because our rates kind of set the bar. Like Japan sets the lowest bar, I feel like, but our rates kind of set the international bar as well.
Yeah,
so maybe they should realize that. And then what do you think would happen if Warsh came in, somehow convinced the board to just cut, regardless of it needing to cut?
That's where I said what will happen is the vigilantes in the bond market will sell off the long-term treasury bond. Yields could go to 5% on the 10-year treasury, and that would cause less economic growth. It would cause the stock market to go down. It would cause financial conditions to tighten. So it could have the reverse effect, right? It could actually have the reverse effect of causing financial conditions to actually tighten. So that's the big risk of him doing that. Remember, he can't control, although they can control through buying, through quantitative easing, buying, long-term treasuries, which he's going to do less of, obviously. But without that, the Fed has no control over long-term rates. So, it could backfire if he tries to do too much. But if he tries to lower rates and the market doesn't want that. So, they're in a real predicament, a real catch-22. We basically have stagflation right now.
Yeah, self-inflicted.
Year over year, GDP growth was only 2% last year. So a lot of people
Didn't they revise that down?
I'm sorry?
Didn't they revise that down too?
Yeah, that was
GDP?
down to 2% year over year on a fourth quarter to fourth quarter basis, which is a big drop from before. So people comment that, the tariffs didn't really affect the economy. Well, first of all, it slowed the economy down because everything, if you look at, real GDP growth slowed down a lot. And then you had inflation higher. Everybody, inflation came down, but actually tariffs probably caused about 50 base, about, I don't know, maybe, a half percentage point increase in the CPI when it would have otherwise would have been. So, you do have that we're still contending with, which is still kind of rolling off. But
to say tariffs didn't cause any, like they weren't impacting the American people is very interesting, especially when you look at the fact that now we're giving back tariff refunds. So clearly some money was somewhere inside of tariffs, right?
Well, yeah, but they're going to go back on with all the different options he has. So, well, the interesting thing, Mark, is whether who's going to get that money, or consumers going to get it, or the businesses are going to get it, or is it going to be, there's lawsuits all over the place now.
You took the words right out of my mouth.
Yeah, the corporations are getting it right now because they're the first ones. But how do we know? Does the consumer benefit because the consumer had to pay higher prices, which is pretty well documented. It's because Marcus, people didn't understand. So the inflation rate really didn't change much, right, after Trump took over with the tariffs. However, that doesn't mean tariffs didn't affect the inflation rate, right? So in other words, if the inflation rate stayed close to 3%, and so people say, well, the inflation rate didn't go up with tariffs. That's not the way you should look at it, because inflation would have been lower if not for tariffs. So even though it didn't go up, it would have been like 2.5% instead of 3%, right? So that's what people don't understand, that it still did cause higher. And most of the offset to tariffs was lower oil prices last year. That was a big factor in pulling the CPI down, probably the biggest factor. Well, we're not going to have that this year, right, to offset. So the tariffs still had, people don't understand and know economics. Tariffs actually cause more economic slowdown than they do higher prices. So we're seeing that. We saw the Atlanta GDP tracker for the first quarter is 1.2%. So we just did 2.2% year over year, fourth quarter to fourth quarter. Now we're going to do 1.2%. So that's 5 quarters of subpar growth since the tariffs. So yeah, I don't know how people can say it didn't affect the economy and it didn't affect the inflation rate. Some of these tariffs just don't make sense. Vietnam, in Vietnam, shoes and things like that they make in Vietnam are literally 50% cheaper to produce in Vietnam than here. So if Trump puts a tariff of 20%, which is what it is now in Vietnam, how does that help anything? Because it's not going to move manufacturing of shoes and apparel, whatever, to the U.S., because he'd have to have 100% tariff in order to make it worthwhile to move to the U.S. So when you do a 20% tariff on Vietnam, all you're doing is put a tax on American consumers, because there's no benefit of trying to reshoring at 20%. Do you follow that? That it would have to be like over 100% tariff in order to get reshoring from Vietnam. So what's the point of having a 20% tariff? I mean, all it does is tax. It's a regressive tax because shoes and are a higher percentage of income of lower income people. It's just a regressive tax in the U.S. Makes no sense at all, and increases the inflation rate.
Yeah, tariffs are definitely something that history's showing, and the Fed, even going back to the Fed, they just keep they don't speak about the tariff impact, I think, enough. Like, they just kind of say to keep waiting to feel it hit or see it hit. But the Americans and people, we know when we go out and shop that things have gotten more expensive since last year. And you can pull out a fancy chart and show us parts here and there and why. But like you said, oil was a big part of the deflationary pressures last year. Oil's going to be higher. The beef prices, going back to the tariffs, we had to change some of our import rules with beef so we could get lower prices there. It's like we should already be sufficient here. It's just a mixed bag in this economic detox that they said we were going through at the beginning of last year.
Also, really important and nobody knows is non-defense R&D spending under Trump is going down 25%. That has been the government R&D spending has been about 20 to 30% of productivity growth. It accounts for 20, 30% of productivity growth in the last 100 years. So that is a big deal that nobody, now that's a little more longer term kind of effect, but you more than pay for federal government research on defense. You more than pay. Every dollar produces like $3, of income. And we have cut that by 25%. And so that's a major long-term negative effect on the economy as well, that people are not really aware of. So, there's other factors. But one thing I left out, Marcus, is the high yield market. The high yield market, even with the private equity getting hit, has actually stayed pretty stable. But I use the Bank of America option adjusted yield spread. That came down to basically match record levels in January of 25. And what that is a sign of complacency, extreme complacency. It was only that low in 1997 and in the fall of 97 and in 2007. And within a couple of years of that, or 2 years, we had a major recession and bear market. So it's a contrarian signal when the high yield spreads are that low, almost 2%, low 2.5% spread. It is actually a contrarian and negative signal that people are being way too complacent about credit. And we've had now 15 months since that hit in January of 25. So it's another variable that's worked well in the past. And so you have to be very aware when complacency on credit gets that high. And we're already seeing some things in the private equity market this year.
So that's yet another sign of the bubble.
Yeah, another sign of a bull market coming to an end. Yes.
So pretty much I can just set my timer for 2027 to like 2034.
I don't know. The timing of this is going to be tough. I mean, it's going to be hard to know exact. It could be as late as the fall of 27. I don't think it's going to be past that. I'd be shocked. Okay. I'll be shocked.
David, so yeah, you're great, man. Sitting over here just giving all this great information. So we need to let Main Street know, because you saw these things coming, you predicted them, you've done this, you've called highs and lows for those who don't know. If you were investing right now, not particularly positions, how would you position yourself for what you see coming?
The next 10 years, if you just invest in an S&P 500 fund, index fund, you're probably going to make very little money, if any, and especially on a real basis on adjusting for inflation. So you're going to need to be more conservative. You may miss out on the next 6 to 12 months of this internet bubble, but if you're a long-term investor, it's worth it at this point. So you want to, if you're going to invest, you need to invest more in income-oriented stocks, and especially for the next a couple of years, more of the income generating stocks that are not cyclical. So that would be one area. It maintains a decent amount of cash, and you got to be tactical. Tactical, I mean, when you do see the downturns, you start to buy, and because believe me, I've been in this 40 years. You're always going to get opportunities. It just happens. It's human nature. People get over enthusiastic, over greedy. Yeah, so I would try to stick with really good, high quality. You want to go to high quality at this point in the cycle. We're late stage of the cycle, and stick with good, low valuation companies, stocks, and don't be tempted to try to jump into to the bubble stocks, the bubble this late in the stage, even though you may miss out in the next 6 to 12 months, because it's really difficult to time. Your question more is about if you're 10 to 15 year investment horizon. So
any horizon.
Yeah, that would be better. So it's very important to be more conservative at this point in the risk cycle. So yeah, that's what, bonds will be fine.
We're just over 40 minutes in, and I really appreciate everyone who's hung out with us. If you're just joining us, remember, we aren't chasing the daily ticker. We're operating within our different set of pillars. We've covered some of the geopolitical intelligence regarding energy bottlenecks. Now we're shifting to more of a macro structural audit. We just finished talking about Kevin Warsh and his effect on the AI boom, productivity, his philosophies, investment strategies, or how you can particularly play them, ways that you can invest inside this economy. I asked David some moves he can make. So moving forward, as we jump into the latter half of this conversation, stay with us, because this defines where the money could be going and what we can see when this cycle hits or when the next cycle hits. So, like I said, we've audited the history, the rotation. Now we're talking about some of the preservation. So whether you're a managing principal over at a family office or you're just the managing principal in your family, right? The goal of these reports are all going to be the same. These podcasts to give you information, help you grow, and help you make your own informed financial decisions. Strategies required to thrive in a K-shaped economy like right now. Don't let the noise of the mere exposure effect dictate your outcome. Use this ledger. Audit your trust derivatives or whatever you may need to do. Make sure you have proper beneficiaries on your accounts. Allocate according to reality, not to the headlines. Let's get back into the last part of this with David Snyder and his AI bubble predictions.
I think bonds are going to have more difficulties because of the government deficit. So I wouldn't go too long in bonds right now. Although if you see a recession coming, I would up my allocation to bonds. I'd completely stay away from private equity right now. I wouldn't even go near it. Or I would stay away from the high yield market right now. Just way too much complacency. You'll get an opportunity within the next couple of years, believe me, when spreads widen. So a much more conservative type of portfolio at this stage. People are just completely, especially healthcare stocks. Healthcare stocks are really attractive again. They had this big run from July until December of last year, and then they gave a lot of it back the last few months. But you have companies like Medtronic, a blue chip medical device company that's been high return on capital, incredible franchise, and they're growing, close to 10% a year earnings, and it's trading like at 16 or 17 times earnings. I mean, this should get a premium because it's recession proof. They don't have a lot of drug exposure where they're trying to. Medical devices, the prices actually are flattened down for most medical device companies in the crosshairs of the Trump administration. And they, you got the demographics with, the baby boomers retiring. So, and it yields like over 3%, a dividend yield. So those kind of things nobody cares about when you're in a go-go market, but they will care. So that's where I would be emphasizing.
Got you. Okay. And so we can't sit here and stay in those positions for ever or forever long. What signs should people be looking for? Say they make the move, because that seems to be the problem when people try to time the market, because you're talking about becoming clearly less, not getting out of the market, but taking less risk. So being more risk off. How do you know when to put the risk back on?
But investing in more conservative equities for one. And staying away from all the risk private equity, high yield. Stay away from those for now. It will come. You'll get a chance, but now's not the time.
Can you expand on private credit and private equity while you stay away from that?
There was so much money put into private equity and private credit over the last 10, 15 years. And it just, when you have that much money, you're competing for capital, which means you're going to offer better and better companies that are running the private equity. They're offering better deals, meaning more risky in order to get the deals. So if your private equity was doing, they were investing in companies and get 10, 11, 12% a year in private credit. You don't get 10, 11, 12% a year without taking risk. Okay. Because if the companies were that good, they wouldn't need to go to private equity and get loans at 10, 11, 12%. So that's telling you something right there. And there's just too much money. Anytime too much money, chases too little capital, you end up making deals that you shouldn't make, which is what's probably happened, especially in the 2021 timeframe, where some of this stuff is coming due. They were making really very liberal terms, a lot of the private credit and even private equity. So, and private equity is tied to the stock market. And so they need exits. And if the market's, this high priced and is vulnerable, they're not going to be able to exit as fast as they would like. And then the things they're investing in a high price right now. So yeah, I'm not a fan of those two areas right now at all.
You mentioned the move in healthcare. You said how healthcare had a run from like October until now. Something else that had a parabolic run that has come back down is gold. What are your thoughts with gold and metals? And I think we saw the basement trade, but maybe you didn't.
Well, you don't really know my view on gold. I don't invest in gold. It doesn't produce anything. But
no intrinsic value.
the biggest thing for gold is it's not correlated with anything. So people think it's correlated with inflation, right? Inflation in 22, the biggest spike in inflation ever, maybe except for the late 70s, and gold hardly did anything. Inflation peaked the core inflation rate peaked in October of 2022. And gold actually then started going up, bottomed. The exact opposite of what you would expect, right? And so then it went ahead this amazing 3 or 4 year run, gold, when inflation was coming down, the steepest it's ever come down, except for the early 80s. So if inflation was really, correlated with gold, this past 5 years really did not work at all. But I have a really funny story about gold. So
Perfect.
I was at Morgan Stanley in 2002, and we had 2 really smart guys, and they gave presentations. And this is when gold was at the lowest. It was like $300 back then. It had been in a 20-year bear market, gold, since 1980 and 82, whatever. One guy gets up and says that we were trying to get out of recession in 2001, too. And so the Fed had really lowered rates dramatically. And he said, it's going to cause hyperinflation. He says, I'm buying gold because we're going to have hyperinflation. And so gold's going to do really well. The next guy gets up and he says, gold, I'm buying gold because there's going to be deflation. We're trying to get out of this deflationary period. And the Fed's lowering rates, but they're not going to be able to. You can't push on a string, was the saying back then. Gold does very well in deflationary periods as well as in inflationary periods. So I thought about it for a while, and these are 2 bright guys. And I thought, I think inflation is just going to be like it was in the 90s, 2.5%, 3% a year. So I'm not going to, I'm not going to believe what they say. I mean, what they're recommending. So what happened? I was right. Inflation went up like 2.5% a year. The other 2 guys were totally wrong. The one that said there was going to be hyperinflation, the one that said there was going to be deflation. Yet they made a fortune. Gold went up like tripled or quadrupled during that period. Where else could you be? So 2 guys were totally wrong and made a fortune. I was totally right and didn't make a penny. So that tells you about gold. There's no, I have researched it. People say really, low real yields. Well, we had the lowest real yields ever last decade. Gold did nothing, right? They say inflation, they say geopolitical events, maybe for the very short term on geopolitical events, but there's no correlation in intermediate to long term. What's the other, oil prices? Oil prices correlate with gold. Guess what? Gold tripled in the last 2.5 years, while oil prices went straight down. This is before February this year. Gold had tripled, while oil prices went straight down for 2.5 years, completely negatively correlated when everybody says they're positively correlated. So, and I also think, I know this is crazy, I also think that gold is going to be replaced by man-made gold someday. There's now
diamonds?
There's a company called Marathon Fusion that's a private company that's raised like 10, 20 million. And one of their goals is to produce through nuclear fission to produce man-made gold. I don't know if you know this, but man-made diamonds, which are really hard to detect if they're not real, have caused the price of diamonds in real terms to go down 40% since 2012. And so with all this new AI and stuff, we're gonna be making man-made commodities, not having
that
to dig underground at some point. Obviously, it's still a theoretical and still way off, but it will probably happen faster than you can think. So that's another risk. But yeah, gold, I've done a lot of research on it, and there is almost no correlation with anything except for price momentum. If you buy it when it's up a lot, if you see it on a 20% move and you buy and you put a tight stop on it, and because when gold tripled in the last couple of years, there were only 2 or 3 10% corrections. That's it. So you never got scared out of your position. So the best way to play gold is on a momentum basis. If it's going up strongly, you buy it with a tight stop. And so because there's no other correlation with anything. And by the way, fair value in the long term, fair value of gold is usually about 50% above the production cost. Production costs right now about $1,700, $1,750. So the fair value of gold is probably like $2,500, $2,600. So it'll eventually get to 50% premium to the cost of gold. It may not happen for 5 years, 10 years, but if you're a long-term investor, I don't think it's a good entry point.
Got you. Are there any commodities that you like? I mean, you didn't like oil, you don't like gold, or any commodities?
I thought copper was pretty good because, it's tied. There's a lot of copper and electrification and all that. So, and there's been some disruptions in copper production around the world, even before the Iranian war. So, yeah, I mean, I think we're short term. Commodities look okay, but I'm never a big believer in commodities. Commodities over the long term, become less part of our economy. And I think between 1800 and 2000, there were only 3 commodities that outpaced inflation. They were timber, fish, and I can't think of the third. But people think oil did not outpaced inflation from 1800 to 2000. Well, gold did. Gold did because when we off the cycle, the Bretton Woods. But so commodities over time, especially with AI now, and with all we have, is going to be less and less important, in my opinion.
And for people listening, they should realize that, David knows what he's talking about. He's made some great market calls. Let's take a second, and I want to respect your time. We've been on here just talking. This has been a great conversation. Take a second and just go back through some of the history, maybe if you can, to let people know, like, some of the things you've called, some of the things you've seen, and maybe how you saw them and how you called them. Even though you may not have said them yourself, you might have wrote it out there, you put it out there. How are you getting these market calls?
So, I have an investment strategy letter, Journey One Advisors, and I've been doing it since 1986. So my biggest call was in the financial crisis. In November of 2007, I made a big call that there was going to be a massive bear market recession. And I actually have that real-time research report on my website that was written in real time. And then in April of 2009, I put out a massive 35-page paper on how this was the start of a new multi-year bull market. So I didn't get the exact bottom, but I did get close. Close in the sense that I got the direction right. So yeah, I did have that. My biggest mistake in investing was in 2000. Even though I knew the market was way overvalued in 98, 99, I stayed with it. And in March of 2000, I called the exact top in tech stocks. They dropped dramatically in the fall of 2000.
Like 70-80%, right?
Yeah, well, not at that point. At that point, they dropped like in half. And
okay.
I went back in and with hands that full, and I got back in way too early. I mean, I knew it was a bubble, and I just didn't realize when a bubble bursts that it takes more than 6 months to revert to the mean. And so I remember like Oracle when it was down like 50, 60% from March till October, and I jumped in and it went down another, 60% after that. So that was my biggest mistake was getting in to, I called the top, but I got in way too early. And I also the Fed had lowered rates in January of 2001. And every time in the past century, when the Fed started lowering rates, the market went up. It was the first time the market didn't go up, Marcus, in 50 years when they aggressively started to lower rates. That's a whole nother point. There used to be Marty Zweig was one of my gurus, and his saying was, don't fight the Fed, especially when they're lowering rates. That completely changed in January of 2001. January 2001, we were down 20% in 2000. The bubble had burst in the internet. And the Fed lowered rates 2 or 3 times in January. The market went up just like it normally does when he starts lowering rates, and then it died. And then the Fed lowered rates 5, 6, 7 more times over the next 2 years, and the market kept going down. That never happened before in the history of our stock market the last 100 years. So this whole thing is no longer valid that don't fight the Fed. We had in 2007, they started lowering rates in in October of 2007. And for the next 18 months, they lowered rates to 0 from where it was like 5.5. One of the big, massive loosening cycles ever. And guess what? The market went down another 40, 50%. So now you have you can't just say, follow the Fed and everything. Tightening still has a negative effect. But on the loosening side, you have to get to a threshold. You have to know when, is it the 3rd interest rate drop? Is it the 7th drop? that's really going to spur the economy and the stock market. It was so much easier to invest from 1950 to 2000 because every single time the Fed stopped tightening and then started to lower rates, the market and the economy responded. Part of it is that what we call velocity of money peaked in 1999. So even if you increase the money supply, it's the velocity. The economic is the increased supply times the velocity, and that has changed since 1999. It's been much lower velocity of money. So lower rates don't necessarily get multiplied through the economy. The velocity is just how much it's multiplied to the. So these people, it's a much harder environment now to invest in because you don't have that ease, that security that if the Fed's lowering rates, everything's going to be fine. We just saw in 2000 and 2008, 2 times where it completely did the reverse. Lowering rates just led to lower and lower stock market, and the economy got worse and worse. Not that it caused the economy getting worse, but it didn't help. So that's a real big distinction versus the prior century. Not many people talk about it.
Yeah, it's definitely the Fed and the rates and the returns and the rate of the return have definitely all changed. We saw
it's not as good a signal as it was in the past.
Right. We also saw like when the Fed cut nearly 100 points. When was that? 24, end of 24, and the interest rates went up. Like the 10-year went up, mortgage rates went up. That goes back to the focus. Yeah, man. This has been a really good conversation. You all right? You need a drink of water?
I'm fine. That's fine.
Perfect. Let me while I have you here, I'm borrowing Dave. David is he's a wealth of knowledge. People, how did you get so smart about all this stuff, David? Like, tell us a little bit more. I'm trying to get back into how did you get to this point?
So I got into the business in 86. So I've seen
86.
everything. I've seen 40 years. I've seen the world end and come back. I got in a year before the stock market crash of 87. So that was a real awakening. So I was always interested in, I was an economics major in college, and I was always interested in the stock market. I practiced law for a couple of years, and then I got into the business, and I've done a lot. I've just really enjoy doing research and writing investment strategy reports. So I've written them for 40 years. So I have I'm really, I'm more historical based. I like to look at historical patterns to see, because they repeat so much. So I have a real good sense of history going back to the 1800s about the financial markets. And so I use a lot of it, apply a lot of these historical patterns to today's markets. And things do change and you do adjust for that. But most of the time, it's not different. That old saying, it's different this time. So so I was very, very research intensive, do a lot of reading, just multitude of research reports and economic reports. It takes a lot of work, and just have a real sense of history, and really, I would say that the biggest thing is just trying to not be influenced by other people. If I do my research, I try to pretend like I'm coming down from Mars and say, this looks like this, or this looks like that. And then I'll, see what it is in reality. And then I'm like, wow, that's so much different than what the status quo is today. I try not to be influenced by the status quo and not accept a lot of things that other people accept. So I tend to be skeptical of anything. In other words, I want to look and make sure that whatever people are saying is actually factually correct and also intuitively is correct as far as their conclusion. So that's a big part, is just doubting everything, and working from there and trying to prove that that's my theory is correct or whatever, my thesis.
Yeah, you're a data dog. Something hits the floor, you're sniffing it, getting ready to go.
Yeah. So, I've done a lot of, I do a lot of research, as I said, and a lot of long research investment strat. One of my reports are very detailed, so they can be cumbersome at times. So I try to, make sure I get the point across.
How many words are these research papers usually? Like general range, or I guess pages for people who don't look at the words?
They can be 10, 20,000 words. Yeah.
Really?
Yeah.
So you do go deep into your research.
Yeah. So in December, I did this massive research report because I wanted everybody to hear my views on almost everything in the financial markets. That's still on my website, and it's broken down into about 20 different categories. So if you want, you can just pick your own category if you want to review it. But I just want to make sure I got everything out to be on the record. of what I thought at the time.
How is it holding up, your research 4 or 5 months in?
You mean how there's everything I've said?
Well, yeah, just from like the December letter.
A lot of it's I mean, a lot of it's coming true so far. So, it's more longer term. We'll see in the next couple of years. It's really more of a longer term strategy piece. I don't, we'll have to wait and see. So yeah.
Perfect. All right. Good. David, this has been a long, great
Yeah, it's
conversation.
long.
It's been a
Yeah.
long,
I
great
really
conversation.
appreciate it. I
I
appreciate it.
guess before we hop off, I found you because obviously people don't realize if they listen to you speak, they've heard a lot of what's being said here, like your mannerisms are being put out in the media, but you're not popping out there. So so your research papers are how people found you. How did you get connected with those people who do that? They just read your work and then just started,
So what
they
happened
reached out
is
to
that
you?
I would send my research reports to Michael Santoli at CNBC,
Okay.
starting in like 2008. And he really liked the reports. And he started publishing my research he was working for Barron's then. And then he moved to uh, CNBC like in 2015, I think. And he continued to write and also, cite a lot of my reports all the way through. So I became known on Barron's and CNBC for my investment strategy pieces. And then, of course, I had my first appearance on CNBC. I got it on December 30th of this past year. So he had always referred to me as the mystery broker. So it was it was pretty cool. It was the unveiling of the mystery broker. Nobody knew my real name until that unveiling on CNBC. So that was pretty exciting and fun to do the unveiling. But yeah, as I said, he was he had written, I'd cited my reports all the way through. Became had a decent pretty big following.
So your good hard work came out. You just put it to the right people's hands, and they realized that was good
Right.
stuff. Yeah, I got David in here like, whew, he needs a drink of water. We're gonna hop up off here in a second, David. I guess let the Main Street audience know where they can find you if they need anything, where they can get that research from, and then anything else you want to tell them before we hop off.
So if you need, my website, my firm is Journey One Advisors, and my website is Journey, the number one, not the number, Journey, the number one, advisors.com is my website where you can find any information you want. There's some research reports. If you want to contact me, you can do it through the website, and we can go from there if you're interested.
Perfect. There you go.
You got Adam Parker, so
Yeah, Adam Parker. The podcast has been doing great, man. We've had a lot of really cool guests on here. I don't know if people realize, and we've done the reports on like live reports from the war since it started happening. It's been really
cool
cool stuff for anyone who's popped on. But yeah, David, you have to come back on here.
Okay.
And also let me know when me and you can do a live session so we can hop on.
Okay.
But unless there's anything else you want to tell Main Street.
That's all. Let's wrap it up.
All right. Main Street Heart meets Wall Street Smarts. David Snyder, the mystery broker. Thank you so much.
Thank you.
Guess what? The 2026 economic landscape does not end when this video concludes. It only deepens. As we've dissected today, from David Snyder's warning on the systematic risk of the AI bubble to the geopolitical frictions in the Strait of Hormuz, the era of passive index fund growth is reaching a structural limit. For the high net worth stewards, the family offices, and Main Street, the people who keep this country going, and the serious allocators, the mere exposure effect is no longer a psychological curiosity. It is a financial liability. You now possess some of the structural intelligence to navigate 3 of the pillars of this ongoing audit. Geopolitical intelligence. You have the maps of the friction points, Hormuz, Taiwan, and the energy bottlenecks that dictate global market stability. Macro structural audit, you understand that we're not tracking sentiment. We're tracking solvency, liquidity, and the shifting balance sheets of the central banks. Tactical wealth preservation. You have the baseline for rotating out of over-leveraged areas, assets, and into defensive areas. Maybe not out of stocks, but just into different areas. Check your allocations. That defines the survival for multi-generational wealth or for anyone who's just trying to make it to next month. Here are your next steps. Re-audit your own personal ledger. review your current asset concentration. Is your exposure to these hyperscalers too much, or is it based on market hype rather than on operational yield? The More economy is in effect. We got a video on the More economy for anyone who wants to learn more about it. It's time to pivot to assets with tangible and properly sovereignty-backed utility. Optimize your stewardship. Your estate planning, trust derivatives, and tax efficiency strategies must be stress tested against the escalation scenarios we discussed. If your wealth structure was built for 2010 to 2020, expansion is fundamentally misaligned for where we're at in 2026. And stay integrated. The macro realignment we tracked today is merely the first half in a long-term cycle. We're sitting in it. Don't let your capital sit idle as the structural tides turn. Feel free, if you want to check out more from me, check me out over on LinkedIn, Sturdivant Sr. over on LinkedIn, or you can check out my financial planning firm, theabcsquared.com. Guys over here on YouTube, Sturdivant Sr. And there you can find some of the latest specific articles. The Wall Street Journal South is on the LinkedIn. And archives of the War Report over there, the Wartime Capital Report, or my LinkedIn or my YouTube channel, that provide some of the adjustments that you just aren't going to get from legacy media. What David spoke about today should be heard by millions of people. Will it? But it should. People need to understand what's happening in the world and just signals to look for. Subscribe to the newsletter, the Wall Street South Journal, and be prepared for the silent war that I just made. It's like a 3-hour compilation going back in the Wartime Report. I'm Sturdivant Sr. This is the Main Street Meets Wall Street podcast and airing on the YouTube channel as well. You had the blueprint, the framework, and some data. Allocate accordingly. Get to work. Main Street Heart meets Wall Street Smarts. Thanks for listening. Share this with someone you love, care about, or who just needs to hear it. Subscribe.